Welcome to The Explainer. Today, we are tackling one of the biggest questions in personal finance, Roth IRA versus traditional IRA. We're going to break down everything you need to know to make a really smart choice for your retirement.
Okay, let's just dive right in. When you really get down to it, the choice between these two amazing retirement accounts, well, it all boils down to one thing: taxes. And more specifically, it's about when you want to pay them.
Both of these paths are designed to help you build that nest egg for the future, but they work on totally different principles when it comes to taxes. And this decision, it's not just some minor detail. It's a strategic choice that can seriously impact how much money you actually get to keep down the road.
And there it is. That's the fundamental question. This one choice is the key that unlocks everything else, every rule, every benefit, every single strategy we're about to talk about. So let's really unpack what now versus later means in the world of IRAs.
This slide just lays it all out so simply. You can think of it as a choice of timing. With the traditional IRA on the left, you get an immediate reward, a tax break for saving today. But with the Roth on the right, you're kind of planting a seed with money you've already paid taxes on, and it grows into a beautiful, tax-free tree for your future. It's this classic trade-off, a little something now or a whole lot more later.
So let's start with the traditional IRA. It uses what's called pre-tax money. This just means the cash you put in might be tax-deductible right away. So, for example, if you contribute, say, $5,000, you could potentially slash your taxable income for the year by that exact amount. That's an immediate win on your tax return. The Roth IRA, on the other hand, is the complete opposite. It uses post-tax dollars. You've already paid your income tax on this money, so you don't get any kind of break or deduction when you contribute. You're basically telling the government, hey, I'll pay my taxes right now, and in return, as you're about to see, you get this massive advantage when you finally retire. So, knowing the rules for actually putting money into these accounts is obviously super important. It's not a free-for-all. The IRS has very specific limits on how much you can sock away each year. Let's take a look at those numbers. For 2025, this is the magic number you need to remember. The absolute maximum you can contribute to an IRA, doesn't matter if it's Roth or traditional, is $7,000, and that's assuming you're under the age of 50.
Now, if you're 50 or older, you get to add a little something extra. It's called a catch-up contribution, and it brings your total up to $8,000. But here's a really key rule to remember. This limit is the total for all of your IRAs combined. You can't put $7,000 in a Roth and another $7,000 into traditional in the same year. It's one limit for the whole shebang.
In this chart, this is where we see a major fork in the road. For a traditional IRA, pretty much anyone with earned income can contribute. Simple enough. But look at that middle row. Your ability to actually deduct those contributions can get limited if you also have something like a 401k at work. But for a Roth IRA, your income itself is the gatekeeper. For 2025, if you're single and make over $150,000, your ability to contribute at all starts to disappear.
Okay, let's hit the fast forward button. Decades have passed, you've saved like a champion, and now it's time to actually enjoy retirement. This is where that whole pay now or pay later decision really comes home to roost. Because how you get your money out is completely different depending on which path you took.
And this right here, this is the payoff. With a traditional IRA, every single dollar you pull out, your contributions, your earnings, all of it is taxed just like regular income. But with a Roth, oh man, as long as you meet those simple conditions, every single penny, including decades of investment growth, is 100% tax-free.
Now with that traditional IRA, the government lets you put off paying taxes for a long, long time. But they won't wait forever. Eventually, they want their cut. And that leads us to something called a required minimum distribution, or RMD for short.
And wow, this is a huge difference. With a traditional IRA, once you hit age 73, you have to start taking money out, even if you don't need it, and you have to pay taxes on it. But the Roth IRA, no RMDs for you, the person who opened the account. You can just let that money grow, completely untouched and tax-free for your entire life if you want to.
So, what happens if you need your money before retirement? Well, usually there's a 10% penalty for that. But the Roth IRA has this incredible superpower. You can withdraw the money you actually contributed. I'm not talking about the earnings, just your own contributions at any time, for any reason, with zero tax and zero penalty. It's kind of like a hybrid retirement and emergency savings account all in one. So, we've looked at the two paths, we know the rules for getting started, and we know what the destination looks like. Now for the million-dollar question. How do you figure out which one is the right fit for your own journey? At the end of the day, the choice really boils down to a single, educated guess about your own financial future. Are your best earning years still ahead of you, or are they happening right now? Let's walk through two really common scenarios to see how this plays out.
Okay, picture this. You're just starting out. Your salary is pretty modest right now, but you're on a great career path. You fully expect to be making a lot more money in, say, 20 or 30 years.
The logic here is just so simple and powerful. Pay your taxes when they're on sale. Your tax rate is low right now, so it's cheaper to just get that tax bill out of the way today. And by doing that, you lock in completely tax-free withdrawals for when you're in a much higher tax bracket later in life. This is exactly why the Roth is such a huge favorite for younger investors.
All right, now let's flip the script. What if you're at the absolute peak of your career right now? You're making the most money you'll ever make. You're in your highest tax bracket, and you expect to live on a bit less when you finally retire.
In this case, getting that tax deduction today could be incredibly valuable. I mean, it lowers your tax bill during your highest earning years, which is fantastic. You're basically kicking the tax can down the road into retirement when you'll hopefully be in a lower tax bracket, making that overall tax bite a lot smaller. This table really just sums it all up, doesn't it? Your choice is basically a calculated bet on your financial future. If you think your income or taxes in general are going to go up, the Roth looks really good. If you think they'll go down, the traditional has a clear edge. And if you just value control and tax-free income above all else, well, the flexibility of the Roth is pretty tough to beat. And of course, that's the real challenge, isn't it? I mean, nobody has a crystal ball. Tax laws change all the time, our careers take unexpected twists and turns. So what's the smart move if you're just not sure?
You know, maybe the most powerful strategy of all is realizing that this doesn't have to be an all-or-nothing decision. You can actually hedge your bets. By contributing to both a traditional and a Roth IRA, as long as you stay under that annual limit, you create something called tax diversification. This gives you a bucket of tax-deferred money and a bucket of tax-free money in retirement, which gives you the ultimate flexibility to manage your tax bill no matter what the future holds.